Hi, I'm Jimmy. In this video, we're looking at Crocs. So Crocs is a small cap stock that's up more than 200% over the past few years. The question is it worth buying today? As you can see in this recent chart, it's pulled back a little bit. Is it worth buying today? Now, to come up with that answer, what we're going to do is we're going to look at the basics of Crocs business. Then we're going to look a little bit at the industry in general, see whether or not where they fall as far as competitors go. We're going to look at the key numbers for Crocs stock, and then finally try to come up with the fair value to see if Crocs is worth investing in today. Now, for anybody who's not sure what exactly Crocs does, basically they design and manufacture shoes for men, women, and children. Now, the shoe industry is a highly competitive industry. In fact, this is just a few of the competitors that Crocs is up against. Now, the toughest part about this industry is it's extremely top heavy. Basically, what I mean by that is, of all the money spent on shoes in general, just a few companies represent the vast majority of the money spent. So when we jump over and look at this chart, well, this is just the three largest companies. Nike is clearly the largest on this in the entire market. By the way, this chart is representing the US athletic footwear. So it's not the entire globe, but I could find all the data we needed for this particular thing, but I think it's a good representation of how the revenue is split up around the world as well. Basically, Nike's the biggest player in the game. Then we have Adidas, then we have Skechers. Now, technically, because this is US athletic wear, Puma is actually up there, but Puma is less popular here in the US, so Skechers, Puma, we can swap them out as we want. Either way, the point is still the same, that just three companies out of all the shoemakers out there, just three companies represent more than half of the revenue generated in this industry. Now, what's interesting about this chart is when we look at Nike. So Nike back in 2016 represented about half of of all the revenue out there in the industry. Fast forward to 2023, fiscal year 2023, they're down to about 40% of the entire industry. But what's interesting about that, if you look at a chart of Nike's revenue has actually gone up, although it has stalled out a bit over the past couple of years. Revenue has increased from about 32 billion back in 2016 to about 50 billion over the past year. But the reason that it's actually declined is, again, so many little competitors have been popping up, taking away market share, despite the fact that the industry itself is in fact growing and Nike by themselves are in fact growing. One of the primary reasons for this with Nike is that Nike has, over the past few years, tried to make a shift from more wholesalers down more to direct to consumer, hopefully trying to improve their margins. With that being said, we're going to look a bit in a minute at the margins of this company, of Crocs, versus the other companies, the major players in the industry, and we'll see how important that actually is. But for now, let's throw Crocs onto this chart to see how Crocs stacks up. Well, interestingly, we can see that, again, compared to 2016, Crocs, over the past few years, has in fact increased their market share while also increasing their total revenue. Okay, now let's throw in the rest of the industry just so we can see how it all looks. Now, one important point to make here is some key numbers are left off of this. For example, a company like New Balance. Now, New Balance is as popular as it is. I know it's a shoe my grandparents love. Well, a company like New Balance is not here because New Balance is in fact a private company. So we don't have all the numbers we need to mix it into the entire pie here. But if you're curious, this is a real interesting data set when it comes to analyzing the entire footwear industry. Okay, now let's jump over and look at distribution. So, primarily in the footwear industry, there's two types of distribution: wholesale, and basically wholesale is when they were to sell through a third-party seller. So, for example, if a company were to sell through a sporting goods store, if Nike sells Nike shoes through Dick's Sporting Goods is the wholesaler for them. Then there's direct-to-consumer. Direct-to-consumer is generally categorized in two ways. One, they have their own store, or two, they sell perhaps direct to the customer online. If you go to Nike.com or Crocs.com and you buy their shoes, that's direct to the consumer. And we can see in parentheses here that industry average sales for fiscal year 2023, on average, 56% of shoes were sold, revenue was generated through wholesalers. If we're curious, Crocs actually was a bit higher than that. About 62% of revenue generated came through wholesalers. Now, as I pointed out before when I mentioned Nike, profit margins are actually larger if you go direct to consumer, although the two kind of cannibalize each other. generally, if you go direct to the consumer, well, they don't have to go to the wholesale. If they go to the wholesale, they don't have to go direct to consumer. So they can be a bit, the two lines of business can cannibalize each other a bit. But again, profit margins are a bit better with direct to consumer. Right now, Crocs is at 62% wholesale and only 38% direct to consumer. So there is some potential upside to go more direct to consumer. Okay, now let's jump in and look a little bit at some recent developments for Crocs' business. So there's a brand of shoe called Hey Dude. It's been an up and coming shoe recently over the past few years, gotten real popular. Well, back at the end of 2021, Crocs announced that they were going to acquire Hey Dude. Now, they were paying about $2.5 billion. That was coming in two different forms. They were paying about $2 billion in cash, and the other $500 million was coming in. They were paying the owners in stock. So a little under 3 million shares the owners were getting. This was a private company, and this was a private company before they bought them. Now, this deal actually closed in the early part of 2022. So this has been officially part of Crocs since the beginning part of 2022. Now, if you're curious where this $6 billion company got $2 billion in cash to pay out the owners of Hey Dude, well, they actually took on $2 billion in debt to get that cash. So when we jump back and look at our market share analysis, well, if we're wondering how Crocs was able to increase their market share over just a few year period, well, of course, buying the Hey Dude brand helped add to their increase in market share, while companies like Nike were losing market share. But the debt that they took on to get this growth is a bit of a concern. So let's jump over and look at a chart of debt. Now, this is a chart of both long and short-term debt. And we can see in 2022, there was a big jump in debt, and we know that's because of the Hey Dude acquisition. But impressively, the company has gone out of the way over the past few years, each quarter paying off the debt, gradually reducing debt from over $3 billion at one point. They've paid off more than $1 billion since they made that Hey Dude acquisition, which is a great way to generate value. It's one of the few things that company could do with free cash flow. I'm okay with this. Them taking out the debt and then paying it down to help the investor, I think, is a good thing. Now, if we're curious how big Hey Dude is relative to Crocs themselves, let's jump over and look at their segments chart. Well, this is a chart of their segments in the last completed fiscal year, so fiscal year 2023. And we can see that Hey Dude represented about a quarter of total revenue. So this is not a small company that they acquired. I mean, it is a relative small company compared to Nike, but compared to what Crocs was, this was a big acquisition that they made. Okay, now let's jump over and look at some key numbers for Crocs' stock. Now, this is a chart, a flow of funds chart that's on the Investors Grow website, and it's actually a simple way to look at the entire income statement. And basically, what we're trying to do is we're trying to track the green line. We want to go from left to right and follow the money from revenue all the way down to net income. And in theory, the wider the net income is at the end, wider it is, the better it is. The wider it is, the bigger the profit margins that they have. So everything we've been talking about going more to direct to consumer and all of that, the goal for most companies is to get that net income profit margin to be as wide as possible. Now, we might look at this and say, well, is this good? To determine whether or not this is actually good, I think it's best to compare it to some industry competitors. So let's first compare it to Nike. Well, here, much to my surprise, when we look at Crocs' net income, well, their net income margins are about 20%. Nike, on the other hand, is closer to 10%, which kind of surprised me actually when I was first doing this research. And if we were to look a little bit closer and we were to jump over and look at something like the cost of revenue, well, we can see that the cost of revenue on a percentage basis, percentage of revenue, the cost of revenue for Crocs is actually smaller than it is for Nike, which means although Nike is selling their products for more money on a dollar for shoe basis, like dollar for dollar basis, Crocs it's costing them less to make their shoes. So for every $100 in shoes that they sell, it only costs them in the 40s while it's costing Nike in the 50s. Okay, now let's jump over and look at Adidas. Well, Adidas had a particularly bad year last year where they actually had negative net income or net loss. And I actually went back and looked at the past 10 years of their net income, and their best numbers over the past decade have been high single-digit net profit margins. So again, nothing compared to what Crocs is currently doing. Then when we jump in over and compare to a company like Puma, well, Puma net income margins 3.5%. Again, these are single digit numbers compared to Crocs. By the way, Crocs, this was not an anomaly. 20% was not an anomaly. They had numbers as high as, I think it was as high as 30%. Now they just got profitable over the past decade, but still, their numbers appear to be significantly better than a lot of competitors. What about a company like Skechers? When we jump over and look at Skechers, Skechers is doing pretty good. Not quite as good as Nike or Crocs, but it's doing decent. But again, Crocs is blowing most of the competitors away. Okay, now let's work our way towards coming up with a fair value for Crocs' stock. So first, let's jump back to the debt chart real quick, because again, this is one of the things I've heard a lot of news about recently, about how much debt that they have relative to their size and all of that. But again, they've paid off $1 billion over the past few years. So I think that this should be considered a positive point for Crocs from an analysis standpoint, because again, if they are paying that off, that's a way of increasing shareholder value. Another way to do it, let's jump over and look at the shares outstanding that is out there right now for Crocs. And we can see that over the past 10 years or so, Crocs has gradually, every year, decreased the amount of shares that are outstanding. Again, for a company that's not paying a dividend, by the way, Crocs does not pay a dividend, but if they're not paying a dividend, but they are in fact buying shares back, that increases shareholder value. So that's a positive sign. Okay, now what about free cash flow? Let's jump over and look at a chart of free cash flow so we can use these numbers to try to come up with a fair value for Crocs' stock. So this is a chart for free cash flow going back the past few years. The dark blue lines, the dark blue bars are historical numbers. The light-ish green bars are analyst estimates. Now, one thing that I always try to look at when I'm doing an analysis of a company, especially a smaller company like Crocs, well, I try to see how many analysts are giving us numbers for each year. And we can see that generally as time goes on, you have less analysts, which probably makes sense. But we have 14 analysts in the first year, then 12, then 4 in year 3. So we have enough analysts, and our numbers that we have is the average. What's the average number for all of those analysts? The big point, I think, to keep in the back of our mind here is that right now, analysts don't really have this free cash flow numbers coming off of last year's historical number. They don't have it growing all that much. But with those numbers, when we jump over and we look at the fair value calculation for Crocs' stock, well, we can see the stock looks a bit undervalued. Now, if you're curious how to read this chart, basically, we're looking at this needle in the middle here. If the needle is on the right side of the black bar that's in the middle, the stock is overvalued. If it's on the left side, the stock is undervalued. It's really as simple as that. Now, we can see that we have a margin of safety here. Basically, what the margin of safety is, if you bought it at the current price and then you sold it at the fair value, in this case, you'd be up 43%. So if 43% is enough of a margin of safety for you, this could be an interesting value. Now, to come up with these numbers, I actually use a required rate of return of 9%. Some people think that's too high, others think it might be too low. Well, basically, that's the reason we include this implied return line here. Here's how that works. If you were to set the required rate of return to exactly 11.26%, well, the fair value would be exactly the same as the current price. It's really that simple. So if your required rate of return is 12% or 12.5%, then this stock is slightly overvalued. You know that because your required rate of return is higher than the implied return. If your required return is only 10%, well, then this stock, again, is undervalued. So that's one way to read that. Okay, now many times I think it's good to confirm whether or not the stock is really undervalued. So to do that, we're actually going to check the historical price to earnings multiple. This is a chart of Crocs' PE multiple going back the past decade. And using the 5-year average, each of the horizontal lines represents a 5, 10, or 20-year average. The 5-year average for Crocs' stock is about 11x. 11x gives us a fair value of $162 per share right now. If we're curious, again, when we jump back to our discounted cash flow calculation, well, the fair value here is 161. So I got 161 with the DCF, and we got 162 with price to earnings multiple. Let's just say all the numbers are pointing towards this being a decent buy right now. Okay, now in my research process, as I get to this point, I'm starting to get real excited about Crocs, but now I like to try to poke holes in my own research to make sure I cover all the bases. So I started digging into where could my analysis be wrong? Where are the potential holes in the analysis. And to best see that, when we jump back to a price chart of Crocs' stock, well, we can see that recently there was a big drop in the stock, which could very well be the opportunity that's being presented to us. But I went back and looked at a bunch of the news to see how wide was the stock dropping then. In fact, the stock has had a few big drops through the past few years. What was causing that drop? Well, to answer that question, I think it's best if we jump back and look once again at free cash flow estimates, because this chart kind of gives us our answer. Basically, the guidance that the company was pushing out over the past few quarters, especially in the past quarter when the stock dropped a lot, the guidance that the company was pushing out was that growth, both for Hey Dude and for Crocs, were going to be weaker than they had previously anticipated. And when I'm looking at these estimates for free cash flow, what's lacking here is growth. I mean, a lot of companies, we did an analysis before on NVIDIA, and the chart was outrageous. Analysts were just having free cash flow climb higher and higher. Here, we have analysts whose job is, by the way, to analyze Crocs and the entire industry, and they have Crocs not going anywhere for the next few years. And that's massively important, because if we were to eliminate the growth from Crocs' stock, our baseline assumption is 2.5% growth, which is about the growth rate of inflation. If we were to eliminate the growth, this is what the new calculation would shake out to be. Now the fair value with no growth, not assuming any inflationary growth or anything, 0% growth, free cash flow stays that way forever. Well, the fair value now drops to $115 per share, and the current price is $111. Now, where I don't think that will happen, I don't think that they will have zero growth, but I do think that it's interesting that the lack of growth, at least over the near term, the pullback that happened in the stock might be called for, might have been justified. So when I think about adding this company to my personal portfolio, I like the company and I like what they're doing, but I don't really love it. I have questions about their long-term growth. Don't forget, they're up against companies like Nike and Adidas and Puma and Skechers. They're up against big players. So I hesitate whether or not it makes sense to add this to my portfolio. Now, because I do like the company and it is something I want to keep an eye on, I'm going to be adding Crocs to my bullpen so I can watch this company consistently and see if the opportunity presents itself, perhaps if the stock pulls back a bit more, or perhaps if there's some clearer signs as to future growth. I think then it could make a lot of sense. Now, if you want to sign up to get access to the Investors Grow website, where we try to make it quick and easy to value companies, I will leave a link to that in the description below. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.